Hi, this is Stephen Meade, lifelong entrepreneur, business owner, and global speaker. Over the years, I've read hundreds of books and spent thousands of hours developing what I call the BullsEye belief system. And I've used that system to develop my own companies, as well as help others learn to be specific, targeted, and focused to get exactly what they want in life. Again, I'm Stephen Meade, and this is the BullsEye Guy podcast. Stephen Meade again, back with another BullsEye Guy podcast. And again, we shoot these things at the Groove radio station, downtown LA. Appreciate Ina, and Eagle coming in. Again, another day of Corona still going on a little bit. We're practicing social distancing still. Eagle's about 7 feet off there. She's back behind the glass. So we are being cautious and careful, but I'm going to switch gears as I always tend to do. Talk about being cautious and careful. I'm going to go back to some fundamentals of finance. All right, we're shooting this now. I don't normally do this. We're shooting this on the 22nd of March because sometimes we shoot them in advance. This will probably air sometime early April, be my guess. And we're going to talk about investing. We're going to talk about stock market. We're going to talk about what's happened in the last week to 10 days that has been frightening, but it really shouldn't be. And if you're watching these in order, again, my last podcast, a lot of my phrasing in there was don't be scared, but be prepared. I'm going to have that carry over to what we're talking about today with investing. So some of this is going to be sort of investing 101 for the more, I'll say, sophisticated investors. Sophisticated to me are money managers, hedge funds, guys who live and breathe and they're in this world every day. This is going to be rudimentary. But for the majority of people, the majority of Americans, what I'm going to share with you hopefully will help with not only some of the volatility and panic and things that are going on now, but just a little bit of education moving forward. We've talked in some of the earlier podcasts. One of them was about how do you be financially independent, right? We said, what's your number? What's your actual definitive number of how much money you want to have saved to live off the interest to be financially independent? And we went through some whole exercises of what's that number and what would you do with it and how do you get there? And part of what you need to do to get there is investing. And investing for some people can be scary. It can be risky. Or it could be something that you are prepared for and understand better when things like what happened in the last week to 10 days. In the last week to 10 days, the stock market has shed or lost as much value. It's gone all the way back to what it was in 2008. So those of you who might had a 401k, that's what I'm going to talk about for a minute. What's a 401k? What's a mutual fund? A term called load balancing, rule of 72, dollar cost averaging, DCA. Look at this. Eagle, do you know what dollar cost averaging is? He's like, over. I'm going to teach you some basic money terms to help you be more excited and comfortable and confident and prepared with what's going on. Let's start with diversification. People right now, the market's down. I had a friend of mine call me just last week. He said, oh my God, the market's down. Are you panicked? What's going on? You've lost. If you don't sell when the market's down, you don't really lose. That's what people don't understand. Like he goes, well, what about that? I said, look, and I'll mention his name, Larry. Nobody knows his last name. Those of you who know me know it's Larry, but I won't mention. And Larry knows some of the same people I do. I said, Larry, there's 3 buckets of people he was talking about billionaires and the money guys. I said, there's some friends of mine who like and understand and know the market. They pulled out a long time ago. They pulled their money out of the market and put it all in cash because they believed the market was going to crash. They're playing the market. They believed it was going to go down and it already moved to cash. Now, what's interesting is if the coronavirus had not come up and the markets continued to rise, they would have bet wrong. Now, they probably still have $100 million or $1 billion. But still, they were betting and thinking, not betting against the economy. They just thought the market's going to go down. So they were looking and they moved their money around and they're much more active managers. You've got another type that says, oh, I'm in this for the long haul. I know where my investments are. I'm not as worried about it and I may move it around. And then you've got the third that says, I'm taking it all. I'm putting it on my private plane. I'm flying to Panama. And that actually happened with guys out of Zurich when they knew this was going to come. But if you were following the market, if you kind of were understanding what's going on, I wrote something on January 24th. And again, I don't play the market. I don't play stocks. I'll tell you why, and I'll, kind of explain a strategy for you to do. But on January 24th, I looked at it and I wrote the following. I said, I don't play the stock market. But if I did, this might be a good time to short airline stocks and go long on hospital stocks. What that means is short a stock means you bet it's going to go down, and go long means you bet it's going to go up. Again, I'm not in the market playing, but I taught sales training 6.5 years. I was licensed broker. I watch economies. I understand kind of what's going on, and that's a risk. It could have been a gamble. Most of you, I don't think, should gamble. And so what do we do with our money as middle Americans? Most people have what's called a 401k. Eagle, do you have one? You do? Oh, very cool. Do you know what it is or what it stands for or what 401k means? So funny. Yeah, ask people, what's your investment? Oh, I invest in a 401k. 401k technically is not an investment. 401k is technically, if you want to be educated at technical level, that is the IRS rule that allows you to invest on a tax-deferred basis. It's Rule 401k of the IRS code. So the 401k was an IRS rule that allowed you to invest your money. Now, we could invest in stocks. This is kind of what I mean. I like to stack things. We could go out and buy, we'll pick any one of the FANGs, Facebook, Apple. We'll pick Apple. We could go out and buy Apple as a stock because we think it's going to go up. And it may go up. It may go down. But that's a risk because we're in one stock that we purchased. Now, if you'd bought, I had my numbers. Actually, I didn't print them out. It's too bad. Could I go off memory? No, hang on. I don't normally do this. I'm going to go to my phone, my trusty resource here. Shaker, my admin assistant, operations biz dev guy, did an amazing job. Gave me some numbers. So Apple in 2009 under the Obama administration was trading at $11. Apple stock, $11. If you wanted to invest, you could say, hey, I think it's going to go up. I think it's going to go down. If you had invested in 2017, by the time Trump took office, it was $120. And the close of price the other day after the coronavirus was $220. What I forgot to do was see what it was right before the crash because it was up probably $600. What's my point? You can invest in a single stock and it's a risk. It could go up. It could go down. If it goes down, you do not lose money unless you sell. The markets are down right now and people are panicked. They're like, oh my God. If you're not selling your stock, you're not losing. On paper, your value is down, but don't panic. So I just went through the numbers. Apple was at 11, then it was at 100, then it was at 220. If you're investing in a single stock, the only way you lose money, there's only two ways you lose money. One, you sell less than you purchase it, which if the markets crash right now. And two, you hold on to it so long it goes out of business. Right? And there's been some of those, Nokia, Nortel. There's been some big companies that did go bankrupt and you potentially lost. That's the risk of investing in a single stock. If you want to be risky, play the stock market. But how do you preclude and help eliminate risk? You diversify. The best form of diversification for middle Americans, my favorite investment tool. I actually have some of these. I do this, and then I'm going to do what I teach you guys next. Very cool. It's called a mutual fund. Most people heard of mutual funds. When I started working at Travelers Group and Financial Services, I was 22. Yes, I'm old enough, People didn't know what a mutual fund was. And we had to explain it to them. Now, for the most part, people know what a mutual fund is, but I'm going to explain it. There's primarily two types. There's a mutual fund and then there's segments. What's a mutual fund? A mutual fund says, hey, if I want to buy Apple stock and I only have $100, well, Apple stock's $222. You can't buy half a stock. And if you want to diversify and say, oh, well, I don't want just Apple because it might go down or out of business, how do you diversify? A mutual fund is simply your money pooled together with others so that $100 goes into a pool or a basket of stocks to help eliminate risk. So as a whole, that mutual fund should go up and down, but it's not going out of business. A mutual fund has never gone out of business. It's almost impossible for every company in a basket or a fund to go out of business. So it's diversified. It's less risky. If you want a better return, if you want a little more risk, there's segmented mutual funds. And a segmented mutual fund says, hey, I'm in my 40s. I've got another 25 years till I retire. I'm willing to take more risk. I'm willing for the markets to go up and down because I'm not selling, and I want technology because technology is high risk, high reward. So I might put 25, 50, 70% of my investment, my mutual fund might be 70% in a technology fund. And that's going to have high risk and high reward and high volatility, but over time, it's going to give me a better return. And then I might put 20% in an international fund because I think an international market's going. And then I might put 10%. I can take my $100 and actually delineate it in different mutual funds as a percentage. That's what 401ks and all these systems and money managers let you do now. But a 401k diversifies your money across so you have less risk. And the term I use, which is what I do, is called load balancing. Again, I keep turning to Eagle here. Load balancing, no idea. Okay. If your strategy, hypothetically, let's say your strategy I just laid out was 70, 20, 10. 70% technology, high risk. I know it's going to, over time, it's going to go up and down, but over time, I want it to be in technology. 20% is international and 10% is maybe bonds or treasury, something a little more stable, but I'm young enough, I have a long investment horizon, I want more money on the risk. At the end of every year, load balancing simply says, out of your total investment that you have in your 401k, the monies will get moved around and reallocated back to the 70, 20, 10 percentage. So if technology does really, really well and your allocation, your amount of money ends up where it's skewed of 85% and the bond fund was down at only 6%, your money gets moved back around and load balanced or reallocated back to the strategy of what you had. Very simple to do, very easy, but then you can say, what's my horizon? And if you're 20, 25, 30, 40, you've got a long horizon, you need more money in the technology sector. You need more money in the high risk sector because that's going to give you high growth over time if you're diversified. As you get older, you want those allocations and percentages to change and invert. And this is what, again, I understand the purpose of government, but God, these people are stupid at times. They just say the dumbest things to protect themselves. And then the idiots in the press aren't smart enough to ask better questions. And yes, I'm not saying I'm the smartest person, but I'm educated enough to say that doesn't make any sense. And what I mean by that is the government says, oh, if you've got an IRA or retirement account, a 401k, oh, it's too risky. You can't allow the average citizen to put money in their own account because if the market drops, like if the market dropped like it just did in March, 50% of the value, if you had 300,000, and I hope you're fortunate to at least have that or more. If you had, 2 or 300,000 30 days ago, right now you probably only have 150. If you're looking on paper, that's pretty scary. But here's the point. If you're 40 or 45 or 50 years old, it doesn't matter because that drop, we hope and believe the world will recover. that market's going to go back up. If you're 60, 65, if you're close to retirement, your money should not have been allocated into the risk pool of something like the Dow Jones or technology. You shouldn't have been in an allocation that might have been 70 technology and only 10% bonds or something, less fluctuating. Your percentages should have changed. If you're getting closer to retirement, those percentages move around where eventually you're inverted, where you have more money in cash or in bonds or in things that are much more stable. If you had 300,000 in the market, you're down 150 on paper. You haven't lost. You're not out. That money you weren't looking at in your 401k for another 20 years anyway. On paper, it's scary, but you haven't lost. As a senior citizen or retirement or something, you shouldn't have been allocated in anything that risky. That drop should have been less. So mutual funds are a great term. Diversification, load balancing. Don't worry about market volatility. And what I mean by that is we're worried and we're scared. But if you're diversified, every company's not going to go out of business. We hope. Again, we're in weird times right now. But people ask me. I get questions a lot. People, well, what do you think? Are we in a recession? Well, what about this, guys? A recession is when you don't have enough fortune. You don't have enough money to buy the things you want. A recession comes when the fortunes of companies and stuff start declining. Industries change. This is not a recession from an economic retraction. Right now, this is a forced, I don't even want to call it, this is a forced retraction. This is a forced shutdown. The airlines weren't managing their business poorly. Right? You see a lot of this. I don't like getting political, but there's people out there on both sides of the equation. Some are like, I don't believe in bailouts. I don't want to bail out the airline. I'm not going to A bailout means that company was stupid and executed poorly and wasted money and didn't do a good job. This is not a bailout. This is a forced shutdown by the government where we need to find a way to protect these industries. And I believe it will. So what does that back to do with investing? If you're in a 401k, your money has been diversified among these different industries, among these different companies, it will return, it will recover. And I want to believe, I want to be positive. I hope and believe and think this will be 30, 60, 90 days at the most. I hope it's less. But if we can get the virus under control, if we can figure out social distancing, some new viral things coming out to control it, that pent-up energy and emotion of the economy is still there. Will it lead us to a recession? I don't know. But if you've got a longer-term investment horizon, you shouldn't be scared. The hard one to do, if we're fortunate enough to still have money and still have a job, and by fortunate, I mean I want everybody to be successful, is DCA. And DCA is the trick. Do you know what? See, again, I keep turning to Eagle. Eagle's like, whew, over my head. He's a lifelong DJ. He just makes money, spends money, and, spins it and spins it, right? You spend money and spin records. Oh, by the way, if you guys can see behind me, I'm excited for them. They've got, here, let me move. They've got the DJ studio set up there where now the DJs can actually come in, spin, record. So the shows, the Groove Radio stuff, you guys certainly check it out and find a way to support them as well. Everybody needs help during these times. But DCA, dollar cost averaging. Everybody's going to say, I suck at math. It doesn't matter. You're going to have to follow me on the math equation. This is the best tool you will ever learn for investing. Pass the rule of 72. I'll teach you the rule of 72 in a minute, but rule of 72 is not a tool as much as it is a calculation method. Dollar cost averaging says, I have two investment options. Eagle, I'm going to give you the choice. I'm going to give you the test. I feel sometimes like Rush Limbaugh, where he's always talking about, not Baba Booey, that was Howard Stern. Who's Rush Limbaugh's guy? I met him once. Bo Snerdley. Rush Limbaugh's talking about Bo Snerdley. Howard Stern's always talking about, his guy. Like, everybody's got these people off camera. One day we're going to flip the camera around. But here you go. Eagle, you have a choice of investing. You have $300 to invest. Option A, You put $300 in a stock. The stock today is at $10. And then the stock goes up to $15. And then 3 months later, it's back at $10. So option A is you've got $300. You invest it all today. It's worth $10. The stock went up and then it went down. And in 90 days, it's worth $10. Option B, you say, I've got $300, but I'm going to dollar cost average. I'm going to put money in every month. I'm going to invest through my 401k $50, $100, $200 a month. Dollar cost averaging says, I'm going to invest $100 every month for the next 3 months. Option B works like this. Month 1, the stock's $10. Month 2, the stock crashes, drops to $5. So month 1, it's 10. Month 2, it's 5. All of you watching me on YouTube can see my hands. Month 3, it returns at least back to $8. Never makes it back to 10. So option 1, you put money in, $10 a share, all $300. It goes to 15, then it's back at 10. Month 2, you put in $100 at 10. It starts and it ends at $8. Do you want option A or option B?
B.
He picks B because he knows it's a trick question. Why'd you pick B? Oh, he's got it. Hang on. He's sliding around. Here he comes. Not on camera, on mic.
I think I picked B because you're not putting up all the money all at first.
Okay.
So that leaves some option along the way.
It does, but we're going to do the math. The math is simple, and this is what I want you to understand of why it's relevant to the market now. $300 day one, $10 a share. That buys you, right? It buys you a certain number of shares, but at the end, you still own the same number of shares. At $10, your investment's still worth $300. You're like, whoo, at least I didn't lose. The other one started at 10, went to 5, at 8. I lost money. At $10 a share, your $300 buys you 10 shares that month because you're investing. The next month, your $300 goes in. It dropped to $5. At $5, you buy 20 shares of that same stock. So the market dropped, but you're not panicked. You're like, well, I hope it comes back up. I'm still going to put my money in. Month 3, it returns to $8 and you buy 12.5 shares. So in example 1, $300, $10, you own 30 shares. At $10, that's your $300. Example 2, you own 42.5 shares. But your shares are only worth $8. 8 times 42 is $340. What's the point? Dollar cost averaging says if I'm investing long term, if I believe, especially in a mutual fund, mutual funds are the best and safest way to go. It's hard to spend $100 or $200 a month on one stock. I think it's just the wrong strategy. But in a mutual fund, if the market's down right now, keep investing. Keep putting money in. You're buying at a share. If you actually listen between the lines of the money managers, if you actually watch that kind of news, some people don't. The managers are out there saying, this is a great time to buy. All these stocks are on sale. Oh my God, I may not see it this low again for another 10 or 12 years. The money managers have a different perspective. They're like, can I buy a good deal? We as average consumers are like, oh my God, the market crashed. It's panic. The news is telling you how bad. It's not bad. It's not scary. Markets go up and down. Dollar cost averaging, if you keep putting your money in your 401k, if you keep putting your money in every month, you're going to buy more shares and more value. So when the market does recover to the same price, you're actually going to be worth infinitely more than you would have been if you stopped investing now and just waited. So dollar cost averaging is a really, really important tip, but you have to do it in a way that you're comfortable and not scared. And of course, do it if you have the funds. But as long as you do, you consistently invest. So the markets are volatile right now. They're up and down. But again, when my friend called me and said, oh, what do you do? Are you concerned? Do you care? I said, no. Number one, I don't play the market. Two, my mutual fund strategy, many years ago, I was fortunate enough to sell a company. I set up my mutual fund strategy, just like I explained to you. This is not, oh, this is good for you and not good for me. I set up a mutual fund strategy. I created my load balancing of what I'm comfortable with, and I've never looked at it again. I don't look at my statements. They don't come to, I don't want to know how much money is in there because, one, I'm an entrepreneur. I may want to invest it or spend it on something else. I'm like, no, that was from a different company. Hide it. Put it aside. Don't even think about it. But if I did, I wouldn't want to be somebody that looked and panicked and went, oh, my God, look how much I'm worth. I've lost so much money. You haven't lost anything. On paper, you're down. As long as you don't panic, as long as you don't sell, as long as you keep investing, and as long as your strategy horizon is long enough. That's the only thing I need to stress. If all of your money was in something volatile and you're 60, 65 or getting ready to plan on that for retirement, this isn't a strategy, but that's your own, I don't want to say your own fault, but that strategy should have been changed. If you've got 10, 15, 20 years ago, this will return. The markets will recover. Have a long-term horizon. Dollar cost averaging is great. The rule of 72, I haven't done in a while. This one's kind of fun. It doesn't really matter as much. Rule of 72, Eagle, no idea. Fundamental math investment stuff. Rule of 72 basically means whatever your investment return is divided into the number 72 is how many years it takes your money to double. So if you can average 6%, divide that into 72, your money doubles every 12 years. If you can average 10%, divide that into 72, your money doubles every 7.2 years. How do you average 10%? How do you average 12? You have to have a bigger risk appetite. You have to have a longer horizon. That's all the way back to where we started with this is if you've got a longer horizon and you put money in mutual funds and technology and can get a 10, 12% return over time, you can double your money and grow quicker than you would at 2 or 3%. So the rule of 72 is simply how often does my money double? It's hard to plan for that because there are no predictive interest rates. There is no predictive rate of return. But you can predict how much you can invest per month. You can dollar cost average even when the market's down. Don't be scared. Be prepared. Diversify through a mutual fund. Create load balancing so you're not all in one industry. You're not all in one sector. You're not all in one geography. Don't put all your money in Latin America. Don't put it all in. Like, diversify and be smart, but mutual funds are great. Again, markets are going to recover. I'm excited about where this is going. I want everybody to be safe. Be smart. Protect your money. Invest wisely. Hopefully this helped. Mutual funds, diversification, load balancing, dollar cost averaging, rule of 72. There you have it. Wrapping up for today. Stephen Meade, another BullsEye Guy podcast. Tune in next week and let's hope everything keeps getting better.